Okay, we're going to start on Chapter 13, which is Consumer and Business Credit. So we have open-end credit, charge accounts, credit cards, and line of credit. An open-end credit's a loan arrangement in which there is no set number of payments. As the balance of the loan is reduced, the borrower can renew the amount of the loan up to a pre-approved credit limit. And so a form of this is our credit cards. That's a revolving credit. Then we have finance charge. It's the dollar amount that is paid for credit, total of installment payments for an item less the cost price of that item. And then the annual percentage rate, the APR, effective or true annual interest rate being charged for credit must be revealed to borrowers under the Truth in Lending Law. We also have Fair Credit and Charge Card Disclosure Act and the Credit Card Act that involves making sure that the consumer is given the truth. We probably all have credit cards. Do any of you, because I heard on the news a couple of weeks ago about having a magnetic sensor in it so that you don't even have to swipe it or something. But the danger of that is anybody around you could steal the information. And it has the little volume-like thing, little waves here. It's a frequency rate. There's a chip in it. You've got one that has the frequency waves.
But the bad thing is if you go out of the country, that's the kind you almost have to have.
Mm-hmm. Oh, really?
I saw that. Yeah, so only one of mine is like that.
Okay, well, I guess I won't be going out the country. But also you can protect them by the little sleeves. There's some little sleeves that you can put your credit cards in, or you've seen the little metal boxes to keep your cards in to try to keep people from stealing your information. But good luck. I mean, they're finding all types of new ways to do things. So
Yeah,
all of us have our.
If they're going to get it, they're going to get it.
Yeah, that's true. That's pretty much true. So this is our information on credit cards. Open-end credit, charge accounts, and credit cards continued. We have unsecured loans, loans that is backed simply by the borrower's promise to repay without any tangible asset pledged as collateral. And these loans can carry more risk for the lender and therefore have higher interest rates than secured loans. And then secured loans, loans that is backed by a tangible asset which can be repossessed and sold if the borrower fails to pay back the loan. And these loans carry less risk for the lender and therefore have lower interest rates than unsecured loans. So these are like homes and vehicles. They can get some of their money back. And then revolving credits are credit cards, loans made on a continuous basis and billed periodically. Borrower makes minimum monthly payments or more and pay interest on the outstanding balance. A form of open-end credit extended by many retail stores and credit card companies. I would, seriously urge you to try to, if you're not on the basis of paying off your credit cards each month, to get on that basis. That will help you more financially than anything else. And when, I can remember when I first started off and I wasn't making much money, his budget was tight. And so what I would do is every time I made a charge on my credit card, I put it in my checking account and I would show it was subtracted. So that when the bill came in, the money was already subtracted as far as I was concerned from my checking account and it was there to pay it. And it was very helpful once I started doing that to make sure that I could pay it off. Okay. So I would suggest that you do that. Now on your credit card bills, let me show this first, how Credit Card Reform Act affects you. Your credit card company has to tell you when they plan to increase your rate or other fees, and you probably have received letters that they're going to do increases. How long it will take to pay off your balance. Now, I could not find that on I was looking over, my credit card from Capital One, and I could not find where it would tell me that it would take this many, months to pay off a balance if you kept a balance on it. Have any of you looked at your credit cards? Just yours does? Which credit card is that?
Capital One.
Capital One?
Capital One does that.
Where do you find it? Because I was looking on mine and I could not.
Well, a lot of them.
Like I've done a lot of them.
Some of them are usually when you have that 0% for so long,
Yeah,
that's when I see it the most.
okay,
And yeah,
okay.
0% would not be hurt.
I couldn't find it on mine. New rules regarding rates and fees and limits, no interest rate increases for the first year. Increased rates apply only to new charges. Restrictions on over-the-limit transactions. Caps on high fee cards. Protection for underage consumers. You know, it was for a while there before they did this credit act that kids that went off to college, they got their first credit card and it was just, oh, this is fun. Just zip, 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 and they'll run up these high charges and they're in debt before they know it. My first credit card, I got it when I went to U of H and my first semester there. I got my credit card from Foley's, if anybody remembers the Foley's. Okay, that was a big department store, so that was my first one.
They push credit cards on these kids.
Absolutely, absolutely. And so,
They push credit cards on
on
everyone.
everyone.
I know, but you know,
On everyone,
when they go
but-
to colleges, they really
they do.
immediately start.
Yeah, you get instant credit, you know, right away. Changes to billing and payment, standard payment dates and times, payments directed to highest interest and balances first. No two-cycle, double-cycle billing, and reasonable penalty fees and protections. No fee of more than $25 to $35 in special cases. No inactive fees. One fee limit for a single transaction. An explanation of rate increases and reevaluation of increases every 6 months. This is to calculate the financial charge and new balance by using the unpaid balance method. The unpaid balance method. So this is in your textbook. On top of page 415. So the first thing you're going to do is divide the annual percentage rate by 12 to find the monthly or periodic interest rate. Round to the nearest 100th percent when necessary. Your second step is to calculate the financial charge by multiplying the previous monthly balance by the periodic interest rate from step 1. And then total all the purchases and cash advances for the month, and then total all the payments and credits for the month. And then you use this formula. You use the previous balance, the financial charge that was done in step 2, the purchases and cash advances that were done in step 3, and minus any payments or credits, which was step 4, and that will give you the new balance using unpaid balance method. Okay, we're going to try this. Carl has a charge account with an annual percentage rate of 15%. His previous monthly balance is $318.20. During July, he charged $35.50 for dry cleaning and may have paid a $45. He bought new shoes for $59.25 and went to a restaurant for $41.10. He purchased medicine for $19 and received a credit of $9.12. They want you to calculate the financial charge for July and then get your new balance. So go back to your steps on page 414, do each one of the steps, and then use the final formula that's in step 5. Okay, our first step is to find our periodic rate, which we would take the annual percentage rate, which is 15%, and divide it by 12, so it's 1.25. That's the first step. The second step is to calculate the financial charge. So you take the previous balance, which they gave you was $318.20, and you want to multiply it times this periodic rate, which was 0.0125, and we get $3.98. Are you good so far? Nobody? Then the next thing that you need to do is calculate the total purchases and cash price. So your total purchases would have been, you had $35.50 for dry cleaning, and you had $59.25, and you had $41.10, and you had $19. So you added all of those up, and you would have gotten $154.85. Is that what you got? Okay. And then we had a payment of $45, and we had a credit of $9.12. So when you added those together, what did you get? $54.12. So then you would plug those numbers in to calculate your new balance. You would take the previous balance, $318.20, plus the financial charge, $398, plus the purchases, $154.85, and then subtract payments or credits, $54.12. So the new balance is $422.91. So how many got it right? Anyone got it right? Okay. What was your mistake? Do you see what you did?
I did 1.25.
First part with the that.
Times
Yes.
I
I didn't
Well,
get
well,
that.
if you did, well, that would be fine. $318.20 times 1.25%.
Right, but I didn't hit the.
But you didn't hit the percent key.
That's exactly what I did.
Right. Okay.
I figured that's where I messed up.
Yeah.
So you got $300 and something dollars.
Okay.
I just messed up big time.
On page 415, in the white area where it says dollars and cents, this is the Fair Credit Billing Act. Gives consumers the right to dispute a credit card purchase or billing error. And probably most of you know this. Your maximum liability from unauthorized credit card charges is $50. Number of days you have to report unauthorized credit card use, and there's no limit. Number of days you have to file a billing dispute, 60 days. Number of days a credit card issue has to respond, 90 days. And maximum number of days to dispute may drag on 270 days, okay? And it's scary when you all of a sudden, and this was before the internet where you could go on and check your charges. You had to wait for 1 month to the next month to get your mail. And that happened to us. I mean, my husband did Men's Warehouse or something and bought some suits. And the guy took his card and went to the back and came back. And we didn't think anything about it. And then the next month, when we got our charge card, there's $3,000 on it for equipment, TVs and all types of entertainment equipment and all that. And, we didn't have to pay any of it, but it was scary. Now you can check, every day you can get online and check and catch something immediately and get it handled. And that happened again not too long ago. I hadn't purchased anything from a magazine, a catalog for 8 years from Frontage. I don't know if you get that magazine, Frontage. And I had charges $840 on it. And then the next day they charged another $840, but I was talking with the credit card company when they charged it again and had it taken care of. But it's just a hassle.
Did you change your credit card numbers?
Oh, yes, they did. Well, no, did I? Oh, yes, immediately when I
Yeah.
called in, they changed the credit card number,
Yeah.
but they had already had a chance to do the second one before the credit card was issued, so.
My girlfriend went to France last year. Went on hot air balloon rides. And I'm like, and you didn't take me with you.
The next method that we're going to look at is calculating on unpaid balance method, the unpaid balance method. And that's at the bottom of page 415. The first step is
This is
the bottom of page 415.
average.
Oh, that's average, I'm sorry. Unpaid balance. Oh, it's top of page 415. Because we did the,
We did the unpaid balance method.
we already did that. We need the average daily, right?
Yes.
Yeah, I'm sorry. We all need to be on page 415. Okay. This one. The average daily. Okay, first step. Start with the previous month's balance as the first unpaid balance. Now this is where it's going to get you. It says multiply each by the number of days that balance existed until the next account transaction.
I don't see that.
That's the key right there, okay? Multiply each by the number of days that balance existed until the next account transaction. Step 2, at the end of the billing cycle, find the sum of all the daily balance figures. Step 3, find the average daily balance, which is taking the sum of the daily balances that you got from step 1 and dividing it by the days in the billing cycle. Calculate the financial charge. It's the average daily balance times, which is in step 3, times a periodic rate. And doing the periodic rate is the same as you've done before, taking the percentage and divide it by 12. Okay. And then compute the new balance as before. We take the previous balance, the financial charge, purchases and cash advances minus payments and credits. Okay, so keep that 415 at the bottom handy, and let's go to, yes, you will need it. Let's go to our little exercise.
Previous one's number 1. Okay.
We have Morgan that has a revolving credit card with 15% annual percentage rate. The finance charge is calculated by using the average daily balance method. The billing date is the first day of each month, and the billing cycle is the number of days in that month. During the month of March has how many days? 31. Morgan's account showed the following activities, okay? The previous month's balance, which was done on March 1, was $215.60. The next transaction happened on the 7th. So between between the 1st and the 7th, 6 days have passed by. Okay. So that is from March 1 to March 6, we have 6 days because it says it's before the previous balance until the next transaction. Then from there, we have the next transaction. So that would be like from March 8th to March 10 was the next transaction.
So you don't go from the 7th to the 10th, you go from the next day?
Yes, because this is from, yes, because this one's done on the 7th. So then the next day would be from 8 to 10. So we would have 3 days, 8, 9, 10. Then the next one is from the 11th to the 12th. So it'd be 11 and 12, 2 days. And then we have from the 13th to the 17th, we have 5 days. Then we have 2 that's on the 23rd. So we have 6 days for those 2, the 79 and the 1943. And then from the 24th to the end of from the 20, is that right? 22 to 23. And then we have 24 to the 31st, 8 days on the last one.
What'd you say about the ones that were on the same days?
23rd, they're considered the same, 1 day. Okay, that would be 1 day. And then from the 24th to the 31st is 8 days.
So the second one on the 23rd,
It's the same first one, it's all done on the same day. It's all done on the same day, okay? It's all done the same day, it's 1 day.
So they're both 6 days in.
Okay.
Do you total those 2 and work as like that?
Yes, I'll show you how it breaks
Okay,
down on
fine.
the next one. But yes, they're considered 1 day, okay? Well, let's see how this works.
Not yet.
Okay, the first thing they're going to do is they're going to figure their periodic rate. So they're going to divide 12 into 15%, and we get 1.25. Do I need to put that back up there?
No, I was just gonna write down the amounts.
Okay.
Okay.
And then we're going to put down the dates. March 1 to 6, 6 days. The previous balance was $215.60. You multiply that times 6 to get $1,293.60. Then we have March 7 through 9, and that's going to be, is that right? March 7 through 9. We've got 3 days. The charge was $125.11, and the unpaid balance was $340.71. But we're going to be multiplying the 3 days times the $340.71 to get the $1,022.13.
Where'd you get the 340?
That's adding the 125 to that. That's the unpaid balance from this to that.
That was, the charge was 125 on the 7th.
You add, and then this is unpaid balance column. So 215.60 is not paid, 125 is not paid. We get 340.71. Then you multiply that to get the daily balance. That's what I'm saying. It's confusing.
Yes, it is.
Okay. Then the next one is 2 days, 10 to 11. The charge was $23.25. We add that. Our unpaid balance is $363.96. Multiply that times 2 to get $727.92. They have computers that do this.
Yeah.
12 to 16, 5 days. That was a payment of $75. So you subtract this. Now this is an unpaid balance. 5 times that, $1,444.80. 17 to 22, 6 days. Again, we have a credit. We're going to subtract it. Our new balance is $234.86. Multiply 6 times that, we get $1,409.16. And then on the 23rd, we have one charge of $79 and the $19.43. So we add these to this to get our unpaid balance of $333.29. Multiply 1 times that. And then the last charge, 8 days, $94.19. 8 times, and add it 8 times this. And then we can add all the daily balances. Add all the daily balances. And then you're going to take that amount and divide it by the number of days. And that gives you 311.31. That's your average daily balance. Then we use that figure times our daily periodic rate to get $3.89 financial charge. And then we just use our previous balance, which was $215.60. And then we have our financial charge. And then we would add up the 125, which was a charge, and the 2325 a charge, 1943 and 94 and 79 and 94.19. Add all those up, and that gives us our charges. And then add our credit and our payment of 75 and 54.10, and that gives us our 129.10. We add and subtract, then our new balance is 431.37.
So everything we did up there was to find the financial charge.
No, the new balance. The new balance. The financial charge and the new balance. Financial charge and the new balance.
Let's get this on that one, right?
Let's look at, okay, let's go to page 416. At the bottom is a try it and the top of page 417. So see if you can go through the process. Bottom of page 416, top of 417. Work it through, and then you can turn and look at your solution and see if you have it. Okay. You're taking, the first one was 1 to 4 days, and the previous balance was 158.
Okay, I got 5.
69, so that's your unpaid balance. So you multiply 4 times that, you get 634.76.
Right.
Then the next one, 5 to 10, is 6 days, and you're going to add, the charge was $55. You add that to your unpaid balance to get your new unpaid balance of $213.69. Then you multiply that times 6 to get 1,282.14. Kayla, did you ever find your 75-cent
I
error?
figured out what I did on the dates. I went 10 minus 5 is 5 days
Oh.
instead of thinking 5, 6,
6
7, 8,
days,
9.
6
Yeah.
days. Okay. And then on the August 11 through 14, 4 days, you had a payment, so you subtract that, and now our unpaid balance is 113.69 times 4,
Okay.
454.76. And then this one is 2 days, charge of 43.22. You add the charge, new unpaid balance 156.91. Multiply that times 2, you get 313.82. So on. So you understand that?
I got all that right until the very last one. Can you go over the last?
The very last one. Well, the transaction was it on the 26th?
26, yeah.
Was it on the 20? So then the next transaction, you're going to need to go the whole cycle. So the last transaction is going to go from that date to the end of the month,
Oh,
the
so
end of the cycle.
You add the 75?
Okay,
For
well-
some reason I subtracted it.
This is a cash advance.
Yeah, I
So,
subtracted it.
yeah, your
So I totally
unpaid
would've
balance.
been right.
It's considered like a purchase, cash advance. So you add it and then multiply it times 6. And then you add all those, these are daily balances, so you add all those, divide by 31, to get 290.15.
Oh, you add all those?
Yes, you add this to get your daily balance. You add all those, the sum of the daily balances,
Okay.
divided by the number of days in the cycle. 290.15 is your daily balance. Multiply that times your percentage, which is 1.5%. Right? Yeah.
So you're just trying to get an average
So his
balance.
finance are $4, not 5,000 and something. Glad I'm not his banker.
Right, then you take your previous balance, the financial charge, all the purchases and cash payments, cash advances, minus any credits or payments. And that comes up with your new balance, 514.86.
Yeah, solution strategy, all this. See.
Okay, next we're going to look at lines of credit. When you're in business, you go to your financial institution and you get a line of credit so that if you've got people owing you money and you're not going to receive it, and let's say you've got your payroll that you've got to take care of, then you can go to your bank and tap your line of credit for that amount of money. And then whenever the people come in, they pay you or something, then you go in and you pay that off. And so you are approved for a certain line of credit. It depending on your business and your credit rating, you could have a $25,000 line of credit, $50,000, $100,000, $1 million worth of credit. And then you tap it and you pay it back and it just stays at that level, goes back and forth. So it's a pre-approved amount of open-end credit based on borrower's ability to pay. The U.S. prime rate, the lending rate at which the largest and most creditworthy corporations borrow money from banks. The interest rate of most lines of credit is tied to the movement of the prime rate. Now, the prime rate, in your textbook, they show the prime rate as of July 2010. This is on page There's the prime rate. On page 418. But the Wall Street Journal will come out with this daily showing what the prime rate is. And it says right here, here's prime rate. It has a little asterisk by it, and it says base rate posted by 7% of the nation's largest banks, the prime rate. And everything goes off of that prime rate. I Googled today just to see what today's rate is, and it really hasn't changed. It's 3.25. It was a year ago that, a month ago that, and this week that. So it hasn't changed. Prime rate has not changed. So let's look at the line of credit example. A firm has $75,000 line of credit. The annual percentage rate is the current prime rate plus the prime rate plus 4.5%. The balance on November 1 was $12,300. On November 7, the firm borrowed $6,700 to pay for merchandise, and on November 21st, it borrowed another $8,800. On November 26th, a $20,000 payment was made on the account, and the billing cycle for November has 30 days. So again, we're going back through from the 1st to the 6th, there were 6 days. And then from the 7th to the 20th, there was 14 days. And then from the 21st to the 25th, there were 5 days. And the billing cycle has 26 to 35 days. So again, we're going by those days. So prime rate. Your prime rate plus 4%. Prime rate, they say, is 8.5%, which is a joke. That was years and years ago. Plus 4.5%, 13%. So the periodic rate's 13% divided by 12, 1.083%. And then we go back through the same scenario that we did a moment ago. 1 through 6, 6 days, 12,300, 6 times that. Then we go 7 to 20, that's 14 days, and we add, charge was 16,000, we add it for the unpaid balance of 29,000, we multiply this figure times 14 days. Then the 21st to the 25th, 5 days, a charge of 8,800, add it, new balance, times 5. And then the last one's 26 to 30, 5 days, it was a payment of 20. And so we're going to subtract, so now we're 1,780 times 5, and we get our daily balance. Then we take that daily balance and divide it by 30. And then our financial charge is that times our periodic rate, 272.81, and the same formula. Previous balance plus charges and cash advances, well, that's our financial charge. Financial charge payments and purchases and advances, and then any payments. Same formula. Same formula. Okay. So look on page 418. And it's our example 3, the bottom of page 418, well actually on 419 where it says the try it exercise. So see what you can come up with on that one. It's at the bottom of 419.
Do we add that to our line? Wait.
Okay, let's look at it. You have your down payment amount is the $12,500 times your 15%, so it's got to put down $1,875. The amount financed is $12,500 minus the down payment, $10,625. Total amount of installment payments is the $309 times 48 months for $14,875.20. So if the financial charge would be the $14,875.20 minus the amount financed, that's the amount of the financial charge, $4,250.20. So the total deferred price is the total amount of the installments plus the down payment, which is $16,750.20.
I got it.
You got it? Okay, good.
It's cost them over $4,000 by
You should pay
Okay, that's as much as we're going to cover today on 13, and we'll catch the other half next class period.
Yeah, I'm thinking so, yeah. We'll do a review next year.
Remember to check your Blackboard under assignments and schedule because there are parts of 13 that you're not to do, so be sure to check that.